Good afternoon, everyone. It's Lyle and Gary back with you here for another quarterly webinar. We've got some good end of the year, end of the year material for you. We'll wait a few seconds here as people get into the room. Hope everyone's having a great day. It's pretty nice outside, Gary, isn't it?
It's a beautiful day. Yeah, beautiful day. Leaves are still popping. Not quite at peak, but still some beautiful fall colors out there. So I was fortunate enough to be driving around today and enjoying that. So that was wonderful.
Yeah, that's great. I got out a little bit too. I was at home for lunch, so just went out and grabbed the mail and stuff. It's beautiful outside.
Saw a buck too on the drive. Thankfully I was with Tim from our office and he spotted it up ahead, so he slowed down, came right across the road. It was a nice looking one too. I'm not a hunter, but Tim and I were saying, man, there's probably some hunters who want to get their hands on that one. So hopefully someone got it.
Yeah, what an opportunity. That's awesome. Good. Well, we can probably launch in here, I believe. So, Gary, why don't you take it away here for us?
Sure. Yeah, really excited for today's webinar as we focus on year-end planning and thinking especially about taxes and how we plan for taxes as we come to year-end. So we packed a lot into this webinar today, so I'm going to try to keep it moving. Of course, we'll have some times for questions, so feel free to throw your questions in the chat or in the Q&A. We'll be monitoring that as we go through the webinar. And really what we hope today is that you hear something or even a couple of things that we've already talked to you about if you're a client of Masters. And if you aren't, we hope you hear something new, maybe a new planning idea that you could think about here before year end. And of course, anything we talk today, any of us on the team will be more than happy to have a follow-up conversation with you about. So our first section is about planning for your lifetime tax bill. And your lifetime tax bill, very simply, is the total amount of income tax. There's other taxes as well, but today we're mostly focused on income tax that you're going to pay from today until your life expectancy. And that's a big number for most of us, probably bigger than we realize. And the reason that we want to start here is that when we plan for taxes for a client at Masters, we're thinking long term. Yes, we're looking at this year. Yes, we have to think about your tax situation for 2023. But part of the consideration of how we plan for the current year is what we reasonably expect to happen in the future. As an example of that, on this first slide, you see what is fairly common. This is a bit of an extreme example, but a fairly common lifetime tax bill for an individual or for a family. What happens is, of course, early in life, you start with lower earnings and therefore lower taxes. And then your career grows or your business grows, your income goes up and your taxes go up. And typically right before you retire, if you fully retire right away, is your highest tax bill. And then most of us, if we retire before we're required to take distributions from our retirement accounts, which is now age 73 for most of you close to retirement. It's a little later for some of you who are younger. What happens is we retire and all of a sudden our earned income goes down or goes completely away, and we hit this middle ground where we're paying very little in tax. But if we've done a good job of saving, and particularly if we've leveraged retirement accounts and pre-tax savings vehicles, that is short-lived because the government says, we gave you a tax break to save money for retirement. When you turn 73, in most cases, it's time for us to get paid. So that's probably lesson number one today is the IRS always gets paid. And so what we want to control is when we pay them and try to get that bill down as low as possible. Because most of us, when those required distributions start, our tax bill comes back up and only grows out into the future because that number generally grows over time. And so when we talk about lifetime tax bill, yes, when we plan, we're thinking about our taxes today, but we have to think about it in the framework of what we expect for the future. And so if we're close here to peak earning years, that informs us because we know that we're in a high tax bracket today, but we're likely going to be in a lower tax bracket in the future. And therefore, I should be looking for tax savings today. Now, that's pretty intuitive. Most of us want to save money on our taxes. But when we think about long term, it also means that when we're down here in these low tax years, if we know that our taxes are going to be higher in the future, we actually want to voluntarily pay tax in those lower tax years because it is going to bring down our total lifetime tax bill. And so we're going to talk about some strategies here today for any one of these situations. If you're in a very high tax year, if you're in a low tax year, even if you're an in-between year, how we think about it and some planning strategies around that, all in the context of what we expect for the future. Also wanted to give a little perspective today about where we stand on tax rates. What we're seeing on this top group.
Sorry, Gary, I don't know. Can you hear? You went out on us.
Sorry, audio issues here.
You're back now.
I'm back.
Yep.
Sorry about that. Okay, jumping back in, my apologies for the audio issues, is we're looking at the historical tax rate here in the United States, and wanted to look at this just to give everybody a little context that tax rates were higher in the past. They have been lower at some other points in the past, but in general, we're in a relatively favorable tax environment today. Now, when we look at this top chart, we are looking at the top marginal tax bracket. So we're looking at the tax bracket for taxpayers making over about $650,000. You say, well, that's not me. Why is this relevant? But typically the rest of the tax code follows that top marginal tax rate. And then we see down here what that average effective rate is for the top taxpayers. Right now, or over time, it's been 22%, and that's about where we're at here today as well. The reason we show you that is that also plays into this lifetime tax bill is, are we in a favorable tax environment? Are we in an unfavorable tax environment? Or are we somewhere in the middle? And right now we would say we're in a somewhat favorable tax environment. We're likely to stay there. Well, we're definitely going to stay there until the end of 2025, but that is when the current tax cuts expire. And if they do nothing down in Washington come 2026, the rates are going to go back up to what they were pre-Tax Cuts and Jobs Act. So even in that context, these next few years may be favorable tax years, and we have to consider that when we look at various planning strategies. This is a little hard to see, but just to give you an idea of what the tax rates are, the numbers aren't quite as important, but the tax rates right now, we have 10%, 12, 22, 24, 32, 35, and 37. Again, those are current rates. Those are scheduled to go back up starting in 2026 if Congress does not do anything. Most taxpayers are going to fall in these bottom four brackets between 10% and 24%. And so again, this is the context with which we want to plan from when we think about tax strategies and tax savings in a given year. So to start off with an example of how we think about lifetime tax planning, wanted to look at how we would consider a Roth conversion, a Roth contribution versus a pre-tax contribution to retirement accounts. So most of us now who save to a 401k have the option of saving to pre-tax in our 401k or saving to Roth in our 401k. And that's a big decision that we have to make. You can also do that in IRAs. You can save to traditional or to a Roth. The traditional IRA gives me a tax break today. Everything grows without me paying tax on it. But when the time comes for me to take that money out, both what I put in and what I earned on what I put in come out as taxable income. With the Roth IRA, I pay tax today, but then my money grows tax-free. Both my contributions and my earnings on those contributions are tax-free down the line. When we think about a pre-tax contribution versus a Roth contribution, for many people, this actually changes throughout their life as to which one is better. And in general, the younger you are and the lower your taxable income, the more favorable the Roth option will be for you. The older you are and the higher your taxable income, the more favorable your doing a pre-tax or traditional contribution is. And so when we go back to that first slide of peak earning years and then low earning years and then RMDs coming in again, it also has the effect here where in these early years when taxable income's lower, when we have more time for that tax-free growth to compound, we want to be looking at doing Roth. But in those peak earning years, if we're making significant money and our taxable income's up and we're only a few years away from retirement, it most likely means that we should be in pre-tax or traditional contributions to get the benefit of that tax deduction today due to us being in a higher tax bracket. That's just one example about how these tax strategies can change and move throughout your life, depending on your earnings, depending on your financial situation, and depending on the tax environment that we're in. So in general, just a few principles to remind you of before we jump into specific strategies. The first one would be when we're in a lower tax bracket, when we look at that lifetime income schedule and we see, hey, we're in a lower tax bracket this year, we a lot of time want to look to actually increase taxable income or at least keep it level. We're not going to make a lot of effort in reducing our taxable income if we expect that income to grow in the future, because we don't want to take these deductions when we're in a lower tax environment. And so that a lot of time is a bit counterintuitive. We always want to save tax, but when we're looking at it holistically, it means that to save tax in the long term, we may actually want to pay tax in certain years. And again, we'll look at some specifics on that in a few minutes. When we're unsure of whether this is a good year to try to increase income or try to decrease income, the other considerations we look at are future tax rates and your future tax situation. So we looked at both those things already. If we expect your income to keep growing, to be higher in the future, we're probably going to look to add some income in the current year. If we expect your income to be down, you're in those peak earning years, we're going to look for tax savings. And then we also want to look at the current tax environment. Again, as I said, these next couple of years are probably years where if you're not sure what to do, it might be worth considering driving some income to your tax return, paying tax at lower rates because those rates are likely to float back up a few percent in 2026. And so those are some of the tiebreakers in a year where it may not be clear whether we should be pushing income or reducing income. When we think about good planning, we know you're going to pay tax over your lifetime. We know you have a lifetime tax bill. So what we want to control is when do we pay it and how much do we pay at those times? That's really what we're looking at year to year. So it's less about, oh, how do I pay no tax? Because we're never going to pay no tax. We're always going to have a lifetime tax bill, but we want to be strategic about when can we pay, when can we be strategic about paying tax so we reduce that overall bill. And just a reminder that any tax break comes with a consequence somewhere else. So the perfect example of this is traditional 401k contributions. When we make a traditional contribution, yes, we get a tax break today and we like that. It drives our income down. We pay less income tax. But the consequence later on is when I take that money out in retirement, it's fully taxable to me as ordinary income. And so there's really very few breaks that don't come with anything else. And so we just have to be aware of that and make sure that we're weighing both ends of the spectrum when considering a tax break or considering reducing taxable income. So Lyle, there, I'm going to pause as we just sit on some of those principles and see what questions we have there.
Yeah, I don't have any questions in the queue. So just a reminder, if you have a question or something you want to point out, please feel free to respond in either the questions or the chat. I'm monitoring both. Just something I was thinking about, Gary. It wasn't too many years ago that we didn't have the option of the Roth. I mean, it's been a long time now, but we bumped into some situations a number of years ago where people really had most of their net worth in pre-tax buckets, and some of the challenges that come with that, if we're not careful, if we don't have this tax diversification that Gary was talking about, it can really run into some difficult situations. I remember one of my clients, she was a widow, and she wanted to take her family on a vacation. She was looking at a cruise to Alaska, but all she had was pre-tax money. And this was going to be like, I forget what the bill was, but it was like $25,000 to take her family on this cruise. And the planning and the manipulating we had to try to do to get this money out without paying ridiculous amounts of tax relative to what she was used to paying was quite a challenge. So it just comes to reiterate, if it's buying a car or taking a family vacation, if we don't have different buckets to take it out, it can really create some tax planning challenges to try to get it out tax effectively. So I just wanted to share that story. I thought it was relevant to the tax diversification that you're talking about there.
Yeah, it's a great point, Lyle. And of course, the Roth requires delayed gratification, which is difficult for all of us, of course, because we're paying all the tax in the year we make those contributions. But the other thing I like to remind clients of is when we're in one of those in-between situations, should I do Roth or should I do pre-tax? We could go either way. My comment is typically, I've never heard anyone get into retirement and regret that they have tax-free money. So
Yeah.
the tiebreaker is going to go to the Roth. I mean, it just gives you so much more flexibility down the road.
Yeah, that's a great point.
Great. So let's jump into some of the specific strategies that we can consider as we again come here to the end of the year and keeping those principles we talked about earlier in mind. So I'm going to start with some strategies to look at in high tax years. So we're looking at those peak earning years, those years where we know your income is about as high as it's ever going to be. So I'm looking to reduce taxes. If I'm talking with a client here at the end of the year saying, hey, we're looking at your lifetime tax bill, you're probably at a peak earning year. Let's find all the ways we can to reduce income while still keeping in mind what that means for the future, because any of those contributions of any of those strategies, of course, are going to come with something down the road. First one's easy, it's just making pre-tax retirement contributions like we've discussed. Next one is increasing charitable contributions strategically. So if you're already doing charitable giving, that's a great way to help a tax situation or to maneuver a tax situation a certain way. One of the examples of this would be for those of you who might have inconsistent income. So maybe you have high income years, then you have lower income years. What we would like to do with charitable contributions if you have inconsistent income is when you're in a higher year, we might actually accelerate some of those charitable contributions in that tax year by putting them in a donor advised fund. So donor advised fund gives you a current year tax deduction, but you don't have to actually distribute the money to the charities of your choice until when you choose in the future. And so what that can do is it can allow us to push future giving that we know we're going to do into a higher income tax year to reduce income tax. And what we would be saying there is, hey, your income tax bracket is going to be higher this year than it is next year. So it's more valuable if we take some more contributions and pull them into current year to increase the deductions that we have on our tax return. So that's a very common one. There's some other variations of that, but in general, just think if you're doing charitable giving, make sure you've had that conversation with your advisor about how you're doing it to be sure that you're fully taking advantage of the tax benefits of that giving. Another thing we have to be aware of as income grows is various tax credits and tax breaks that we actually lose if our income gets too high. And so there's all these little levers in the tax code. It's fascinating and it's maddening at the same time, but it means that there's opportunity there, and there's also some pitfalls there that we have to be aware of. So there's a number of different credits, different deductions that as my income grows, I might lose. And so what we want to look at there is if I'm in a high tax year and I'm really close to a tax credit phase out. One of these examples of this would be for a younger couple who's got high earnings and have children at home. There's a child tax credit that does phase out at higher income levels. And so if I'm looking at your tax situation saying, wow, you're really close to this credit phasing out, that means that if your income's too high, your effective tax rate will actually be higher than that chart we looked at, that 24% or that 32%, because not only am I paying more tax, but I'm also losing a credit. So my tax is going up there as well. And so we have to watch for some of these spots in the tax code where it's not just the federal income tax rate that we're paying, but it's also the loss of a credit or the phase out that we might be paying. Another very common one is the qualified business income deduction. So if you're a business owner and you're in a certain type of business that are specified in the tax code, for this example, I'll just take professional services, accounting, consulting, financial advising, these sorts of things. There's a point in the tax code where you lose this deduction on business income. And so what can happen is, and there's some complexity to the calculation. So what can happen is if we're looking at a tax projection, we can look and see, wow, if you make whatever the number is, a few more dollars, your effective tax rate on those next dollars might be 40, 50, 60, and I've even seen as high as 72%, because I'm losing deductions while I'm also adding income. And so it's very important to know where those lines are, know what your unique situation leads to as far as phase outs go, and just thoughtfully plan around those. And then the last thing, which we will talk more about at the last section of the webinar, is to make sure that your investments are being managed in a tax efficient manner if they're outside of retirement. So if you have an investment account that's just a joint or individual investment account, it's not in an IRA or a 401k or a Roth, you have to pay income tax on dividends that are paid, on interest that's paid, on any capital gains from sales of securities that you would make in that portfolio. And so if you're in a high tax year and you have a non-retirement investment account, you really need to watch that you're not pushing too much income through your investments and therefore reducing the return of that investment account, because the returns you keep are after tax returns. And so if I'm in a high tax year, but let's just say I've been doing a lot of trading in my account, or the person managing my account is trading a lot and generating all sorts of taxable events, it might push my income up higher, and then subsequently for that portfolio, push my after-tax return down lower. And so especially in those high tax years, you need to be aware of how your portfolio is positioned and make sure that whether you're managing it or somebody else is, of course, we do this here at Masters, that you're managing that in a tax efficient way. What about low tax years? Low tax years, our goal is to pay taxes, believe it or not. But that's what we're looking to do. When we're in a low tax year, we want to pay taxes because it reduces our lifetime tax bill. And the caveat I put in here, of course, you want to pay taxes at a lower rate than you are in the future. So we know in the future you're going to be paying taxes at 22%, but this year I know you can pay some taxes at 12%. We want to pay taxes at 12%. So some things you can do there, we've already talked about Roth, but certainly in low tax years, you want to be making Roth contributions, and could be an opportunity to maybe load more money into those accounts if you have it. A second opportunity would be if you do have investments in a non-retirement account that have grown. When you're in the 12% tax bracket, you can realize long-term capital gains at 0%. So that's a pretty good deal. There aren't too many free lunches in the tax code, but that is one of them. And so that's something to look at. That's something we look at a lot, especially for those of our clients who are retired and are in lower tax years living on fixed income, is if I have some gains here that have appreciated, I might want to purposely sell those securities, realize that gain because I'm paying 0% on it, and therefore I'm increasing my tax basis for free. Another thing we want to look at is Roth conversions. This is something that we do a lot of, really for all our clients, but especially those clients that are in that low valley in their lifetime tax bill. That's a great time to look at Roth conversions. The difference between a conversion from a Roth contribution is a conversion is when you take money from your IRA, your traditional IRA, and you roll it over into your Roth IRA, thus creating a taxable event. And you can do that in any increment you want. So if you have a $1 million IRA, you could move $50,000 of that over to a Roth IRA, pay tax on that $50,000, and now those funds are in a Roth and growing tax-free into the future. So again, very, very common strategy that we look at and use in that valley year, but could also be a strategy we use in lower tax years for clients who are still working as well. And then just be aware of the effective tax rate of realizing income. What I mean by that is going back to some things in the tax code that phase in and phase out. There's also some of those items when you're in a lower tax environment that you get some tax breaks if your income's low, but if your income grows too much, those tax breaks phase out or go away. A prime example of that would be your Social Security income if you're retired. If you're receiving Social Security income, only a part of your Social Security income is taxed. The percentage of which it's taxed is based on how much other income you have in addition to Social Security. Now, some of you, many of you are in the situation where it's taxed at the maximum rate, which is 85% of your Social Security gets taxed. But some of you are in lower tax environments where only a part of your Social Security is being taxed. And if we increase income, more of your Social Security will be taxed along with it. And so we just have to be aware of, if I add income, is there anything else that's going to drive up the amount of tax I'm owed? And if so, we've got to consider if it's still the right strategy for you. But what about these in-between years? I mentioned these earlier. Hey, in these in-between years, when you can go either way, what should you be thinking about? The goal here is if I can pay tax, I'm not sure what my future tax rate's going to be, but I can pay tax at lower rates than I think I'm going to in the future, I probably should drive some income forward. If I think I might be lower in the future, maybe I'm not totally sure, but I think it's a reasonable assumption, I might look to drive my taxable income down. Another thing we're going to look at here is bullet point 2, to look for opportunities to combine tax strategies while keeping our taxable income at a similar place. What that means is, instead of just doing a Roth conversion or just doing additional charitable giving, well, what happens if I do additional charitable giving and I do a Roth conversion? The Roth conversion drives my income up, the charitable contributions drive my income down, and now I may have achieved a Roth conversion but not moved my net taxable income all that much because I combined it with some deductions. So I might take some high tax year strategies and some low tax year strategies and combine them together, depending what's going on in that year. One example of this that we had that worked out really well is there's some other charitable strategies that involve annuities, or what you'd call split interest gifts, where you give a charitable gift, but you get a partial something in return, usually an income stream, while also you give dollars to a charity. And so there's a bunch of different versions of that. But what we had one year is we had a large gift go into one of these mechanisms. It generated a large taxable or tax break because of the charitable contribution. We said, well, we've got this big tax break. Let's make sure we use it. And what we did is we had extra charitable contributions. We looked and we had appreciated assets, like I had talked about previously. We had some assets that had grown in value and grown pretty significantly, that we said, well, we could sell those assets, generate a capital gain, but end up netting out and paying no tax because I'm driving up income with the gain, but I'm driving down income with the charitable gift. And so that's some of the strategies you can use and combine together and lump them into the same year to maximize your tax benefits. So Lyle, I'm going to take another break with that section as we just went through high tax, low tax, in between, and see what questions and comments we have on those.
Yeah, again, no specific questions. I thought it would be helpful though to mention just that we have some very sophisticated planning tools that really help us identify some of these spots in the tax code that can be pitfalls or traps for us. Some of the things where we're losing deductions or there's phase outs. It's helpful to be able to visually see where those are at. So that's some of the, this isn't just a blind, trying to figure this out. There's some nice tools that we can use to really pinpoint where those ideal spots to be and to move one or the other with Roth conversions or charitable deductions or some other way to push and pull income.
Yeah, and you need those tools, Lyle, because the tax code is so complex now. Again, there's so many of these hidden. It's almost like going through a fun house where you turn a corner and you don't know there's a trap door there, there's something that's going to send you the other way, jump out and scare you. You don't know that without having the full picture in front of you. And it's certainly not effective to have the entire tax code, which I don't even know if the whole code could fit in our office. It's so long.
Right.
You need some sort of technology partner to make sure that you have everything out in front of you. And certainly we leverage that in all of our planning, because the last thing any of us want with taxes is to be surprised. Being surprised that in April when you get your taxes done is not a lot of fun.
No.
Now it's more fun to be surprised with a refund than a large bill. But even so, if I get a big refund, that means that I just gave a tax-free loan to the federal government, and very few of us are interested in doing that on an annual basis. And so that's another thing we do is some years we'll run projections, we'll look at numbers, say, there's nothing specific here that we think makes sense to do, but it's information that helps us know, but here's what you can expect at tax time. Mm-hmm. You're going to owe this, you're going to get a refund of this. And just that alone, I think, is a huge advantage in the planning process.
Yeah, it wasn't that long ago, Gary, that we're trying to do this stuff with spreadsheets and try to figure it out. And it was really tricky. And there was times that we did some really good planning, but we missed one little thing, and it wasn't a huge deal, but it was still a little bit of a surprise. So the sophistication that has come around with technology has been fantastic.
Great. Well, the last section we have today is talking about tax efficient investing. And I mentioned this earlier, but I wanted to go through some of these specifics here because I don't think it's something that a lot of us think about, a lot of us are interested in reading about, but it's a really important component of your long-term financial picture. And so to start off, just wanted to highlight a few strategies and then we'll dive deep on each one of them one at a time. First one we're going to talk about is asset location. That strategy speaks to where you keep what types of investments. So in which account should I hold my bonds versus my stocks, my income producing assets versus my capital gain producing assets? And we'll look at that in a little more detail. Qualified dividends. Qualified dividends are taxed as capital gains. And remember, some of your capital gains are taxed at 0% in a lot of cases. And even capital gains that are taxed at lower rates than ordinary income. So the qualified dividend element is very important as well, which we'll talk through. If you hold mutual funds are required to pass through their gains each year to their shareholders, the vast majority of them. And so if you're not aware of that, your mutual funds could be less tax efficient than you realize and could surprise you with distributions that flow on to your tax return. Gain loss harvesting, we talked about this a little bit, but we'll dive into digging deeper on when do we harvest gains, when do we harvest losses, purposely push one or the other. And then we'll talk a little bit about municipal bonds. I think most of us are familiar with municipal bonds, but I wanted to look at who should be holding them and who shouldn't, because there is some math involved on who municipal bonds are good for from an investing standpoint and who they might not be right for. We're going to start with asset location. This is something that has come up more and more over the last decade as far as planning goes. And it's thinking about if I have good tax diversification in my investments, which means I have some money that's tax deferred, like a 401k or traditional IRA. I have some money that's tax free, like a Roth IRA or Roth 401k. And then I have some money that we would call taxable. And that's just money in an investment account that's not in a specific retirement account. So a joint investment account or an individual investment account. And so as we're in the accumulation phase, before we really need income from our investments, we want to be thinking about what assets we put in what buckets so that we can maximize the after-tax return of a portfolio. And so this chart shows you what different types of investments are from a tax standpoint. Are they efficient from a tax standpoint, or are they inefficient from a tax standpoint? So I'm going to start on the efficient side. Of course, low yielding investments are tax efficient because they don't generate much return. So we can hold those pretty much wherever we want. Tax managed stock funds. There are some funds and ETFs, some of which we leverage here at Masters for client accounts that have a specific mandate, not only to, of course, perform, but to keep the taxable distributions or the taxable income that's passed through the investment to a minimum as much as possible. And most of those work really well. We actually just ran through our analysis here at Masters with our investment review committee of what taxes are going to look like for the funds and the ETFs that we hold. What we're seeing is these tax managed funds do a fantastic job of keeping the tax bill extremely low for clients without losing out on performance. Large cap and total stock market index funds, balanced index funds, basically all index funds are what's next on this list. And index funds are relatively efficient as well because an index fund is just buying the whole market. We're not doing a lot of active trading, so we're not generating a lot of gains. And so these are all assets that really you could hold anywhere, but ideally you would hold these in your taxable account because they're not going to pass through much gain that then flows onto your tax return each year. So the way you want to think about this chart is the efficient assets are better to hold in taxable accounts. The moderately inefficient and very inefficient are better to hold in retirement accounts. Moderately inefficient accounts would be a money market fund that's got a much better yield on it. So now money market funds are yielding plus or minus 5%, as well as bond funds, which now are yielding 5, 6, or 7%. We ideally would hold those in an IRA or potentially in a Roth IRA because we're shielded from the tax. Because most of our return from a money market or a bond fund, and long-term, all of our return is going to come from that income that's being paid. Well, that income's taxable each year and the year that we receive it. In addition to bond funds, active stock funds would also be less efficient. Those would be mutual funds that are picking stocks and doing a lot of buying and selling and trading, therefore generating a lot of capital gain, which comes onto your tax return. And then there's a few other things here that we list that are very inefficient. So real estate funds, just because of some rules around how they're taxed, are not always super efficient, depending how they're structured. Of course, again, active funds where there's a lot of buying and selling, and then corporate bonds that have a higher yield. Maybe you have assets that are yielding 6, 7, 8%. If they're paying current income, all that income's taxable in the year that you received it. So way to think about that is I'm holding a high yield corporate bond portfolio. Let's say I'm getting 8% on that in income. I'm feeling pretty good about that. But if I'm holding that in a taxable account, and even if I'm not super high income, but I'm paying a, say, 25% tax rate on that, I'm not making 8%, I'm making 6% after tax. So I might want to think about putting that in an account that's sheltered from paying annual tax on it. Next thing to talk about is the tax efficiency of a mutual fund or an ETF. So we've already touched on this a little bit. When it comes to mutual funds, they generally are going to be less tax efficient than an ETF. ETFs have some inherent advantages. The one that we're seeing here is when a mutual fund trades. And so if I hold a mutual fund and I want to get some money out of that mutual fund, the stocks and bonds in the mutual fund are sold to generate cash, which comes to me. That all happens within the mutual fund. So there's a lot of buying and selling going on there. With the ETF, there's actually what you could think of as a middleman in the market that the ETF can swap securities for to raise cash or to keep their portfolio the way they want it to. And that is not a taxable event. So the big picture here is, in general, ETFs are going to be more tax efficient than mutual funds. And there are even ETFs that have supercharged that with a specific mandate to be tax efficient. And that's generally what we use here at Masters, which has worked out very well for those of you who hold those in taxable accounts. So that's just something that we all need to be aware of, is what type of assets are we holding, and are they helping or hurting our tax situation? Next thing is gain loss harvesting within, again, a taxable account. So we're not talking about an IRA or Roth IRA. We're talking about a taxable investment account where dividends are taxed and gains are taxed in the year that they're generated. When we look at tax planning, this provides a great opportunity to manage when we pay tax. We know eventually we're going to have to pay tax on capital gains unless we hold them until we pass away, and then our family can inherit them with a step up in basis and pay little to no tax on those. But assuming most of us are going to need to use our investments in retirement or for other things that come up, we want to be aware of when we pay this tax. And so what this example shows you is, let's just say I'm holding two investments within a portfolio. One of them has performed well and has a capital gain. Another one has performed not so well and has a capital loss. What I can do is I can sell both of these securities in the same year, and I can realize a gain and realize a loss. And my loss will offset my gain that I've realized. So this is something, again, that we look at here at Masters in our client portfolios, where there are opportunities to match gains and losses, and where there are opportunities to potentially drive capital losses to help reduce some income. Now, we're limited to only $3,000 a year that we can actually deduct on our tax return for capital losses, but also then where might there be opportunities to generate capital gain in years where I'm paying 0% on my capital gains. And so again, we have to be mindful of what's in our portfolio and some of these strategies that we can apply to improve our after-tax return. So I talked about municipal bonds, and municipal bonds are really in an interesting spot right now just because of all the things that have been happening with interest rates here and with the Federal Reserve and what they've been doing with rates. And the obvious comment on municipal bonds would be, well, if I'm in a taxable account, I should hold municipal bonds because they're federal income tax free. That makes sense. However, the market adjusts for that. So if I own a municipal bond, I'm not going to get the same return as I am if I own a U.S. government bond. I'm going to get a lower return. And that's just the way the market sees it. And so the benefit of holding municipal bonds is going to be dependent on your tax situation. The higher your tax bracket, the more likely it is municipal bonds will benefit you. And the lower your tax bracket, the less likely it is that municipal bonds will benefit you. What you're seeing here is, in the gray line, is the U.S. Treasury yield curve. So that's the yield on U.S. government bonds, which don't have a tax advantage to them. The dark blue line is the yield on municipal bonds, highly rated municipal bonds. What you see is there's a difference because the municipal bond yield is adjusted for someone who's in a high tax bracket. And so what we're seeing here is there's actually a pretty wide gap on these longer term bonds between municipals and between US Treasury bonds if I'm in a very high tax bracket. Tax bracket example here is 40%. So if I'm in the highest tax bracket, I should definitely be holding municipal bonds. If I'm in the 32% tax bracket, it's almost certain that I should hold municipal bonds. But if I'm in the 12% tax bracket, municipal bonds probably don't make as much sense. And so this is just showing us that we have to adjust that municipal bond yield for the tax bracket that I'm in to compare it apples to apples with if I would just hold US Treasury bonds or if I would hold normal taxable corporate bonds. Just something to think about. Municipal bonds are a good tool, but they're not necessarily the end all be all for every single investor. It really depends on your tax situation. The last strategy I wanted to touch on here are Roth conversions. We've talked about a lot about Roth conversions today. If you couldn't tell, we're big fans of using the Roth conversion strategy in low tax years. We do quite a bit of it here at Masters, of course, when it makes sense. And this is a great synopsis of how we think about this for our clients. If you have a higher tax rate in retirement than you have today, it makes sense to do some Roth conversions, pay a lower tax bracket today than in the future. If I have a beneficiary, let's say one of my children, who has high income, and they're eventually going to inherit my accounts, it might make sense for me to do a Roth conversion because I'm going to pay a lower tax bracket than they'll pay when they eventually inherit. Because when they inherit my IRA, guess what? The bill comes due. You've got the year of death plus 10 years as the beneficiary to pay the tax owed on that IRA. If they inherit a Roth IRA, that comes to them tax-free. Now, they still have to liquidate the account within 10 years, but they don't pay any tax on it. So if I'm sitting here saying, oh, well, I'm in the 22% tax bracket, it doesn't make sense for me to do a Roth conversion. Well, if you're in the 22% tax bracket, but you have a beneficiary who's in the 32 or 35% tax bracket, it might make sense to look at a Roth conversion so that the overall tax bill is lower, assuming they inherit that someday. If you have available funds outside of your retirement account, it's another plus for doing a Roth conversion. The reason being, the Roth conversion generates tax. We have to pay tax in the year we generate it. And so I need money to pay that tax. If we take money out of our IRA to pay tax on a Roth conversion, we've significantly muted the benefit of that conversion. We want to keep the dollars going that are coming out of the IRA. We want to keep them going to Roth. So if I do a large Roth conversion, that might come with a tax bill of $10,000 or $20,000. If I have assets outside my retirement accounts to pay that tax bill, that's a plus for doing Roth conversions. And then the last thing is, the longer my time horizon, the more likely it is that a Roth conversion is going to benefit me. It's another reason why in that valley of the lifetime tax bill, we have a golden opportunity to do Roth conversions, because typically that valley comes somewhere between age 60 and age 73. And so that means if I'm 65 years old and I do a Roth conversion, I've got money in the Roth that's going to grow for 10, 20, maybe even 30 more years after that. And all that growth is going to be tax-free. So to wrap this all up, your tax picture needs to be evaluated every year, no matter what. Some years you might employ some strategies. Some year you might group some strategies together. And some years we might not do anything. But we need to look every year to make sure we're adjusting for changes in your income, your situation, and changes in tax policy, because that tends to change a lot down there in Washington, D.C. Your investment philosophy has a greater impact on the taxes in your portfolio the bigger that portfolio is. So if you have a taxable account, the larger that account is, the more important it is that you have a tax efficient mandate on the account. And so you have to be aware of how that is going to translate onto your tax return year after year, and really think about, what assets am I holding in that taxable account? How are they being managed? How much buying and selling am I doing? How much income is being driven through that account? Because that can jump up and get you on your tax return if you're not watching it closely. Of course, last, plan with a tax bill with the lifetime tax bill in mind. High tax years reduce income, low tax years probably push income, and make sure you're aware of that valley. We all have it. Some of us it's longer, some of us it's shorter. That's a golden opportunity to really lower your overall lifetime tax bill. And then, of course, death and taxes, two things that are sure in this world. At least with taxes, we want to pay what we're owed, but we don't want to leave a tip. And so that's how we think about planning from a tax standpoint. Of course, we have to pay the taxes we're owed, but our goal is to get that lifetime tax bill as low as possible and make sure we avoid the surprises so we're not leaving that tip at the end. So Lyle, that's what I had for a day. I know we just ran through a lot on those strategies. So tell me what questions we have or where we should go back and dig a little deeper.
No, that's a great job, Gary. Thank you for doing that again. I don't have any specific questions that came through the portal. Just a couple thoughts that I had, and most of this is just reiteration of things you were saying. But some years it might not seem like it might not seem like we're doing a lot. Like trying to decide, do we do a Roth contribution or a pre-tax contribution? But it's those little planning steps that we take each year. We forget about what compounding does for a lifetime when you're making good decisions year after year for decades upon decades. We've got some planning software that really show, I mean, it can turn into hundreds of thousands of dollars just by making the difference between going with pre-tax or a Roth contribution each year. So it's really just doing those little diligent steps each year. Planning can really add up to a big amount of money down the road. And the other thing, you said it 3 or 4 times, but just keep reiterating, usually from the day somebody retires, and if that retirement, of course, looks different from each person, but we'll just say stop full-time employment until age 73. Those are the sweet spot years, and really that's where some big, more significant planning can be done. And we really just I just worked on a plan for a new client, and we combined a few strategies together, and that's really fun when you couple together some charitable giving and some Roth conversions and throw in some you do some charitable giving, use appreciated securities. There's really some fun, powerful things you can do in those sweet spot years. So that's one of the areas that we're really always looking to maximize this planning in those spots. So just a couple comments, but Gary, you did a great job. Thanks for going through that.
Yeah, and Lyle, just to reiterate the first point that you made, I think it's fair to give a range to this. You can tell me if you agree, but most multi-year Roth conversion strategies add somewhere between a couple $100,000 to over $1 million in ending wealth to a plan.
Mm-hmm.
Now, again, each one's a little different, depends how much room, but when we model that out, and we can model that out and project those savings, which is really helpful for all of us who are making these decisions. We're not talking about, a few $1,000s. We're talking about a few $100,000 or even upwards of $1 million if we do good planning, especially in that valley. So just to reiterate, I find it really helpful to see those numbers and play that out so we can be confident in the strategies we're employing. And the other thing I would mention is sometimes when we really dig into a tax strategy, it's not intuitive. But when we look at the numbers, it makes sense. So for example, if we have a client who's in the top tax bracket and going to be in the top tax bracket likely for the rest of their life, maybe they own a business, they have significant assets, significant income, just likely they're going to be up there forever. What would our brain say? Well, find every way you possibly can to reduce taxes. And certainly we're going to look to do that. But there's also a flip side of that says, no matter what I'm paying, if I'm going to pay the same thing the rest of my life, there actually may be argument to do some things today that increase income just to pay it now and not pay it later when the money has compounded, because it's really that compounding that does it. So
Yep.
It's usually intuitive, but it's not always intuitive. And that's why we need to take a measured approach and be strategic about this every single year.
Yep. Good stuff.
Well, thanks everybody for joining us today. We really appreciate your time. Of course, anything you heard today that you have questions about, please follow up with us on that. Send us your questions, send us any comments, and we'll look forward to catching up with you here over the holiday season. Enjoy the rest of your evening. Thank you.
Bye.